Hey guys, welcome back to ASX Trading Den for the second installment of Trading Explained. Today we're going to be talking about dual listings and how we use dual listings to help us make informed trading decisions. Get started. So what are dual listings? Basically just any stock or security is a better term, listed on two or more different exchanges. Stock price should be approximately the same when you are considering currency differences, transaction costs, share splits, stuff like that. So when you look at like Mesoblast, for example, Mesoblast has a 5-to-1 share split in the differences between the two listings. So you adjust for everything and then the share price should be around the same. A popular way to dual list is also by using ADRs, or American Depository Receipts. So we have examples which are like BHB, which is listed in the US, Rio listed in the US, and Sony, which is listed between the US and Japan. Pros and cons of dual listing. So why would a company actually want to do it? It's basically the main reason is for access to additional capital. So, I'm sure that you've heard of cap raises, but cap raises where companies want to raise more capital to purchase something or expand or pay off certain debts. By dual listing, they get access to both markets a lot easier. You also get increased liquidity in the stock. But the cons involved are the costs, so it is more expensive, obviously, to list in two different countries, as well as if there's different accounting standards and stuff like that, there may be need for additional staff. And another big thing is that it places large demands on the management, because management need to inform both markets to the best of their standards of new news in the company and stuff like that. So traditional arbitrage is where traders would buy or sell the stock on one exchange and then convert their shares to a foreign market share. I will attach a Chat with Traders episode where they go into details on this in the description below. But basically, like in the episode, they talk about how one of the days he saw that Sony was up 3%, I believe, and then he thought that was too high, so he shorted it, converted it over, also used the currency exchange to adjust for that currency exchange risk, and then sold his short in the pre-market, in the market open in the US. So the problems with traditional arbitrage plays is that there can be a huge risk. So if, for example, right, let's say that we have a stock that rallies 15% on very minor news, and you want to short it because you think that by the time that it's readjusted, it's going to actually go down, then you have this 4 hours of extra time where people have the time to digest that, and because of that you can end up basically with your face ripped as well. And the reason for that is because you take gap risk, right? So same things as overnight risk. It's also not applicable to most traders because you have to have the right broker and account size, and it's very expensive to do. So most traders cannot get access to this share exchange deal. It's like typically you have to have the right broker, you have to have the right size of position as well, and you have to be willing to pay quite a bit to be able to do it. So we offer almost 200 dual listings, which will be released soon. We offer our primary dual listings as well that are going to be released within the next week. If you want any new ones, you can just send us an email. We're always trying to respond to our emails within 3 days or so. But basically, so we look at primarily listings on the American exchange, the Frankfurt exchange, and the London exchange, I believe, as well as the Toronto exchange. But really just depends on the stock, and we actually look for the highest volume to get our dual listings. So if it's listed on like 3 exchanges, we're going to try to look for the highest volume listing. So how can we use them to our advantage? So when a stock has a larger than average price difference, there is a potential play based on the stock adjusting to the price equivalent. So that can be done in two ways, which we're going to go over. So there's pivots and price discrepancy. So price discrepancy refers to this example, which I'm about to go into more detail in Novonix, where there was a 40-cent difference in the price discrepancy, which is about 6%. Sorry, 8%. 8%. And we got a 7-to-1 risk-reward ratio on this trade, just from a normal entry based off of what we saw, and it was a very, very simple trade to get. So as you can see here, we have Novonix. This blue line here is the expected target price, 582, and opens up, rallies straight to that, hits it straight away, and so you would have gotten taken out within the first 15 minutes. Just perfect, like really great trade. You can close up for the day and leave. You don't need the rest, and this is the whole kind of point that a lot of traders realize, is you don't need the entire trade. You just need a good enough part. And so anyway, and then this is the next one, which is using it as a pivot. So we have ORE here. It opened up, the price equivalent is 32. There's a difference of 28 between the low and the 32. There was also the initial scalp just from the entry, like the opening print to the equivalence price, but it was not even 1%, so I don't really include that. But this is assuming that you did the trade to the absolute best, which obviously is not that likely to happen. But it shows just how they can have an actual pivot from that point. VUL, we also have the same kind of pivot here, as you can see. Price equivalent down here, opens up, smacks down, not even within 5 minutes. It's up above that point, way above the opening print, and just starts rallying back to the previous days. JHG, we saw today, the equivalent price is 57.57, and it opened up, tries to push up, can't push up, so you start on your short, it starts to break down, and you could have made about 100 pips out of that, really great, and then it actually went even lower. This is my favorite magnet plus pivot example from recent days, which is WTC. So this is a 5-minute chart, right? So it opens up, moves up, and then starts to show some weakness. We're short, and it just tags to the cent, this level, and then just starts to reject back up. So there is a lot of examples of where these levels can be strong. It always depends on quite a lot of factors. This is not any kind of financial advice, because of the fact that really when it comes down to it, these are just ideas of levels that could be important, and the dual listing prices often do become important. Anyway, I hope you guys like this short little summary. If you guys have any questions or anything, just let me know. Always happy to respond and always happy to help. All right, thanks for subscribing, and thank you guys for all the support. See you later.